you know, when you stand at the base of a huge hydroelectric dam, you don't usually just stare at the water pouring out.
Right, no, you're looking at the massive concrete walls.
Exactly. You look at the sheer scale of it, the vibrating hum of the turbines inside, the physical force required to actually generate all that power.
The infrastructure is really what commands your attention there because, I mean, the water is essentially just the byproduct of that engineering.
And right now, everyone is staring at the byproduct of the AI revolution, right?
Yeah.
We're all totally captivated by the chatbots, the video generators, the consumer software side of things.
Just the flashy stuff.
Yeah, exactly. But today, we're taking you deep inside the dam. We're looking at the power-hungry physical infrastructure that is actually running this new world. So welcome to the deep dive.
Glad to be here for this one.
Our mission today is to unpack a highly detailed, aggressively bullish investment thesis on a company called CoreWeave. Ticker symbol is CRWV. They're an AI neo-cloud company. And they just experienced a rather violent 21.5% single-day stock surge.
Oh, it was massive. It is a remarkable case study in real-time market dynamics. I mean, we are looking at a company sitting at the absolute bleeding edge of computing infrastructure, and Wall Street is currently engaged in this high-stakes tug of war trying to figure out exactly how to price it.
Yeah, and for you listening, this is really a masterclass in how modern tech infrastructure is financed, how it scales, and how it defends itself, because we're looking at a fascinating puzzle today.
It really is a paradox.
Right, we're talking about a company sitting on a $99 billion revenue backlog, $99 billion, yet they are simultaneously losing money on a per-share basis.
Which throws a lot of traditional investors off.
Completely. But it's a puzzle absolutely worth solving.
Okay, let's unpack this. In the first quarter of 2026, CoreWeave's revenue hit just over $2 billion. So they more than doubled their revenue year over year. It was a 111% increase.
Which, you have to remember, is an astronomical growth rate for a hardware-heavy business. We're not talking about a SaaS company scaling software here.
Right, they have to physically buy and plug in machines.
Exactly. And the projections we're looking at are even more aggressive. Analysts are forecasting 147% revenue growth for all of 2026, and then nearly another 100%, 98% to be exact, in 2027.
That's just wild.
To put that in perspective, the entire sector's compound annual growth rate is projected at 46%. So CoreWeave is growing at roughly 3 times the rate of its own industry.
They're completely lapping the field. I mean, Morgan Stanley actually raised their price target significantly up to $91, based primarily on that exact acceleration of customer demand.
Yeah, the demand isn't the problem. Right, but here is the paradox I mentioned. Despite bringing in over $2 billion in a single quarter, they posted an EPS loss, an earnings per share loss, of $1.40.
Yeah, they missed consensus estimates by 23 cents.
My brain immediately goes to an analogy here. It's like building the world's most profitable toll road, but you're currently spending absolutely every cent you have just paving the asphalt.
That's a great way to look at it.
Still, I have to push back on the enthusiasm a bit. How does a company double its revenue and still miss its earnings estimates by such a wide margin?
What's fascinating here is that the earnings miss isn't a failure of their operational model. It's actually a fundamental, deliberate feature of their current strategy.
Wait, missing earnings is a feature?
In this specific phase, yes. You have to look at what they are doing with their capital. They are aggressively front-loading their CapEx, their capital expenditures.
Buying the GPUs.
Buying tens of thousands of GPUs, securing vast amounts of data center space, laying down industrial-scale power, cooling infrastructure, all of it. They're spending heavily today to ensure they can actually capture and service that $99 billion revenue backlog before a competitor does.
Because if they don't buy the GPUs now, someone else will. So if they slow down spending just to protect their quarterly EPS and make Wall Street happy,
they bottleneck their own future revenue.
Yeah.
Precisely. The proof that this strategy is mathematically sound lies in a totally different number from their Q1 report.
which is
Their gross margin. CoreWeave's gross margin remains incredibly strong at almost 70%, 69.38%.
oh, wow. Which is, I mean, that's almost a software-like margin, but they're dealing with heavy physical depreciating hardware.
Exactly. That 70% gross margin is the golden metric for the bullish thesis here. It proves that once these servers are plugged in, once the infrastructure is deployed and customer utilization stabilizes, the unit economics are highly, highly attractive.
Right. The heavy lifting is just the initial purchase, securing the real estate, setting it all up.
Yeah. Once the compute is flowing, the toll road is highly profitable.
But okay, stellar unit economics immediately attract competition. That's just business 101. If the margins on renting out AI compute are really that good, why aren't traditional cloud providers or even other neoclouds just buying GPUs and eating CoreWeave's lunch?
Well, that brings us to their defensive wall.
Right. Here's where it gets really interesting. Because CoreWeave's primary moat is their strategic partnership with NVIDIA. And our sources highlight that this partnership gives CoreWeave preferential GPU allocation.
And in the current AI landscape, as we know, GPU supply is the ultimate bottleneck. Smaller neocloud competitors simply cannot match CoreWeave's ability to secure the silicon.
Right.
It's this incredible supply-side advantage that basically starves out newer entrants.
I've heard people compare it to being on a VIP list for an exclusive nightclub. But honestly, I don't think that does it justice.
No, it's bigger than that.
It's more like securing the only heavy rail freight line out of a booming coal mine. Like, if you control the transport, you control the market, regardless of how many other people want to sell coal.
That's a much better analogy. But getting the chips is only half the battle. The other moat is about what happens once a customer actually integrates those chips into their workflow.
Switching costs.
Exactly. That brings us to the switching cost mode, which is honestly often misunderstood. Integrating enterprise or government AI training pipelines into a cloud infrastructure is an incredibly complex engineering feat.
Right. It's not like swapping out a hard drive or, just migrating a standard web app to AWS.
Not at all. AI clusters rely on highly specialized networking topologies. They often use InfiniBand rather than standard Ethernet just to allow thousands of GPUs to talk to each other simultaneously.
Because when you're training a massive language model, those GPUs have to share data constantly. And if the network topology isn't perfectly optimized, you get latency.
And in AI training, even microseconds of latency can literally ruin the efficiency of a multi-million-dollar training run.
Wow.
So if you build your entire software pipeline and networking logic on CoreWeave-specific architecture, trying to migrate those workloads to a competitor requires a massive engineering overhaul. It introduces severe latency risks, downtime. It's a nightmare.
That puts that $99 billion backlog into a completely different context. It isn't just a flashy metric for an earnings call.
No, it's quantitative proof of lock-in.
Right. Customers are committing immense amounts of future capital because they know they can't easily jump ship. And they know CoreWeave has the hardware density they need.
And we are seeing this lock-in validated by some very specific, heavy-hitting new partnerships, too.
Oh, like the Leidos deal.
Yes. CoreWeave recently announced a deal with Leidos to deliver secure, sovereign AI cloud services for the U.S. intelligence community and the Department of Defense.
Which is huge.
And on the other end of the spectrum, they were just selected by Flow Traders as their primary AI cloud platform for high-intensity, low-latency financial model training.
So you have high-frequency trading and national security. Those represent two of the most demanding customer profiles on the planet.
Without a doubt. The Flow Traders deal proves CoreWeave's technical superiority in environments where, like I said, microsecond latency is literally the difference between profit and loss.
Right.
But the Leidos deal establishes a profound regulatory and security moat. Stepping into the U.S. government and classified AI space requires compliance with brutal security frameworks.
Yeah, they don't just hand those clearances out.
Exactly. Earning that clearance validates CoreWeave's architecture on a global stage. Think about it. If the U.S. intelligence community trusts your infrastructure with sovereign models, regular enterprise customers are going to feel very secure putting their proprietary corporate data there.
It's the ultimate stamp of architectural approval. But, okay, let's talk reality here. Building infrastructure to defense-grade standards while simultaneously trying to fulfill a near $100 billion backlog that requires capital. A staggering amount of it.
Oh, massive amounts.
Over the trailing 12 months, CoreWeave secured approximately $28 billion in combined equity and debt financing. They spent $17 billion on GPU CapEx alone.
Those are capital expenditure numbers you typically associate with sovereign nations or, like, legacy energy conglomerates, not a single growth stage tech company.
Right. And their total debt sits at $25 billion, while their market cap is hovering around $40 billion. So I have to stop and play the absolute skeptic here for your listening.
Go for it.
$25 billion in debt for a $40 billion company. That sounds fundamentally terrifying on paper. Why is Wall Street tolerating this level of leverage without just aggressively selling off the stock?
It's a fair question. To understand Wall Street's comfort level, we have to look at a crucial financial milestone from March 31st, 2026. CoreWeave closed an $8.5 billion debt facility, specifically their DDTL 4.0 facility.
Okay.
What makes this groundbreaking is that this facility actually received investment-grade ratings, an A3 from Moody's and an A-low from DBRS.
Okay, let's break down the acronyms, because I think that's where the actual story is.
Yeah.
DDTL stands for Delayed Draw Term Loan. Why is that specific structure so important for them?
A delayed draw term loan acts essentially like a massive, pre-approved credit line. CoreWeave doesn't take the full $8.5 billion in cash on day one and just start paying interest on it while it sits in a bank account.
Where they would crush their cash flow.
Exactly. They only draw down tranches of that cash exactly when they need to pay for a new batch of GPUs or, say, bring a new data center online. It protects their cash flow and ensures they're only paying for capital as it is deployed into revenue-generating assets.
Okay, so the structure is highly efficient. But why did it get an investment-grade rating? Because this is the first time in history that high-performance computing infrastructure has ever secured that kind of rating. Sophisticated credit investors like Blackstone aren't exactly known for taking wild bets on high-growth tech debt.
Well, they aren't betting on the tech. They are analyzing the collateral quality. Wall Street is looking at that $99 billion backlog and treating it almost like utility payments.
Interesting. So the collateral isn't just the physical GPUs, because those depreciate pretty quickly.
Exactly. It's not just the hardware. The real collateral is the guaranteed cash flow visibility from CoreWeave's locked-in multi-year customer contracts. The debt load is undeniably heavy, but it is highly structured to mitigate risk.
The sources mention a floating rate tranche and a fixed rate tranche at around 5.9%, maturing in 2032.
Yeah, and the fixed rate protects them against macroeconomic rate volatility. Plus, the 2032 maturity gives them a nice long runway. But more importantly, the lenders impose strict financial discipline mechanisms.
What kind of mechanisms?
There's a debt service coverage ratio, a DSCR covenant of 1.15x that kicks in beginning in June 2027.
Meaning for every dollar of debt obligation they have, they must generate $1.15 in operating income.
Exactly. It creates a hard floor for their operational efficiency. So yes, they are pouring every cent of free cash flow back into infrastructure. There are no stock buybacks or dividends here, but the debt is secured by ironclad contracts and policed by stringent covenants.
Okay, so the operational model is hunting, the moats are deep, the heavy debt is actually highly structured and disciplined. So how is the stock actually performing? Let's look at the chart, because it tells a very different, very volatile story.
It's been a wild ride.
Yeah. As of yesterday, July 30, 2026, the stock closed at $73.90. Now, that was a 21.5% single-day jump. But even after that aggressive pop, it is still down roughly 50% from its 52-week high of $153.
It has been a grueling downtrend for retail investors. I mean, the 13-week return was down nearly 40% before this recent reversal.
So what causes a stock with fundamentals this strong and institutional backing this deep to drop by half, only to suddenly gap up over 12% right at the market open yesterday? The sources point to a capitulation washout pattern caused by forced selling. Let's decode the mechanics of that.
Sure, if we connect this to the bigger picture, it's a perfect lesson in how market mechanics can completely divorce a stock's price from its underlying fundamentals. A capitulation washout happens when a large holder of a stock is forced to liquidate their position, regardless of the price.
This is dumb big at all.
Yeah. In this specific case, the selling pressure came from the Situational Awareness Fund, run by former OpenAI researcher Leopold Aschenbrenner.
The fund faced liquidity issues, right? And they had to unwind their portfolio.
Yes. And when a fund dumps millions of shares onto the open market in a very compressed time frame, it artificially depresses the price. It just completely overwhelms the normal equilibrium of buyers and sellers.
So the stock plummets simply because the supply of shares temporarily exceeds the demand, completely independent of CoreWeave's actual business health.
Exactly. Citadel eventually stepped in to absorb that block of shares.
Hold on, though. If Citadel absorbed this massive sell-off at a discount, why wouldn't they just slowly bleed the stock out to capture a quick profit? What immediately changed the market's mind to cause a 21% spike in a single day?
Because a washout implies that this artificial selling pressure eventually exhausts itself. Once Citadel absorbed that supply, the artificial weight on the stock was lifted. But you are right, the mere absence of selling isn't enough to cause a spike. You need a catalyst.
Right.
And right at that moment of exhaustion, we got profound fundamental validation from the broader market. Microsoft and Meta released their earnings.
The hyperscalers.
Yep. And in those earnings calls, they explicitly confirmed that macroeconomic demand for AI compute isn't cooling off at all. They committed to spending billions more on infrastructure over the next several quarters.
Wow. So you have a stock that was artificially compressed by forced liquidation, suddenly receiving aggressive macro validation from the absolute largest tech companies in the world.
That is exactly why the stock snapped back like a coiled spring. The technical selling pressure vanished at the exact moment fundamental demand was reaffirmed. That's why Citi immediately upgraded CoreWeave to a buy with a $160 price target.
They closed their negative catalyst watch too, right?
Yeah, because the fundamentals finally reasserted themselves over the plumbing of the market. The broader consensus rating is now a moderate buy with a target of roughly $136, which implies an 84% upside from current levels.
An 84% upside sounds incredibly compelling, and the overall bullish score from this thesis is a 7.5 out of 10. But that leaves a 2.5 margin of doubt. We have to pivot to the immediate risks threatening this setup. I want to play the skeptic again because the bear case here is substantial.
Let's hear it.
We discussed their CapEx strategy, but the reality is they are running a net margin that is down over 25%. They're deeply, deeply cash flow negative right now. But the far larger red flag for me is the insider activity.
Yeah, that's a big one.
Over the last 90 days, insiders at CoreWeave have dumped a net 29.1 million shares. There have been over 1,300 individual sell transactions compared to just 105 buys.
It's a stark contrast.
And looming right around the corner is a highly predictable event, the share lockup expiration on August 15, 2026. So if this company is positioned so perfectly, if the unit economics are stellar, why are the insiders rushing for the exits and unloading tens of millions of shares right before the lockup expires?
It is the absolute right question to ask, and it is the primary short-term danger to this equity. A lockup expiration means early investors, founders, and employees who were previously legally restricted from selling their shares are suddenly allowed to enter the open market.
Meaning a ton of new supply.
It dramatically increases the supply of available shares, which traditionally pushes the price down as those early stakeholders take profits.
The insiders are clearly trying to front-run that flood of supply, right?
They are locking in gains, which is common, but it always looks terrible on paper. However, while insider selling is a headwind, it's a known quantity. Wall Street knows August 15th is coming. Institutions have already modeled the dilution. Citi explicitly noted this expiration in their upgrade.
So they priced it in.
Largely, yes. The reason analysts are looking past this overhang is because they expect the fundamental business performance to absorb the new supply.
Because Oppenheimer expects CoreWeave to report Q2 revenue at the absolute high end of their $2.45 to $2.6 billion guidance.
Exactly. You have a collision course of catalysts here. You have a wave of insider shares about to hit the market in mid-August, sure, but you also have a potentially massive earnings beat dropping right around the exact same time.
I see.
The institutional thesis is that the underlying fundamentals, the revenue growth, the Leidos integration, the Microsoft and Meta CapEx confirmation, all of that will completely outshine the temporary technical pressure of the lockup expiration.
Right. And once that August 15th date passes, and those shares are absorbed by institutional buyers because we are already seeing fresh institutional interest, like Gulf International Bank UK, establishing a new position, that final technical overhang is removed from the chart.
The market hates uncertainty. Once the lockup is in the rearview mirror, investors can focus entirely on that $99 billion backlog and the execution of the DDTL facility.
So what does this all mean? For you listening, this deep dive isn't just about whether one particular stock goes up or down. It's a real-time lesson in how early-stage infrastructure monopolies are actually built.
Truly.
We're watching a company dig its defensive moats with exclusive hardware access and complex networking architectures. We're watching them finance an incredibly ambitious vision, utilizing historic, highly disciplined debt structures, rather than just diluting their equity.
It's a masterclass in capital allocation.
And we're watching them navigate the turbulent, often irrational waters of forced market liquidations. CoreWeave currently represents a very specific medium-term window, perhaps the next 3 to 9 months, where insatiable, fundamental demand for AI compute is violently colliding with temporary market mechanics like fund washouts and lockup expirations.
If I can leave you with one final thought, something to really chew on that goes beyond just the equity pricing. We briefly touched on CoreWeave, partnering with Leidos to build sovereign AI clouds for the U.S. intelligence community. I want you to think about the global geopolitical implications of that capability.
Oh, the balkanization of the cloud.
Precisely. Up until now, the public cloud has been largely borderless, right? Data flowed across oceans to wherever compute was cheapest. But if every major country eventually demands its own highly secure, localized, sovereign AI infrastructure to protect its national data and its classified models,
It changes everything.
how will the traditional borderless hyperscalers survive against hyper-specialized, highly secure, nationally siloed neoclouds? We are also focused on which tech giant has the smartest consumer chatbot, but the real AI wars might not be fought over the models at all. They might be fought over the physical sovereignty of the data center.
It's a profound shift in how we think about global networks.
Yeah.
And it all comes back to the infrastructure. We spend all our time looking at the water, but the real power, the geopolitical power, is in the concrete and the turbines of the dam itself. Thank you for joining us on this deep dive. Keep questioning the systems running the world around you, and we'll catch you next time.